As usual, we are going to introduce our speaker for today, the star for this session, CY So. CY So is a chartered market technician, CMT chartered holder, and he has more than 10 years of trading experience in local and international stocks and also futures market. He is also a certified NLP trainer and also a certified HRD Corp trainers as well. He's a professional coach with extensive experience in coaching individuals with performance improvement, behavioral change, self-empowerment, and personal breakthrough. He's also the excellent lead trainer. Without further ado, please allow me to pass it over to you, CY.
Hi everyone, good evening. Welcome back to our LLF webinar session. So today's session would be about, I will be sharing about trading strategies and opportunities in the futures market. I hope you are all doing well today and are ready to learn some valuable insights. Now, did you know that the futures market has unique features that you can actually take advantage of that the stock market does not have? And as you may have already noticed that the stock market and futures market are entirely different markets. Each market has its own unique characteristics. However, many people who enter the trading world, right, they tend to trade almost everything without a clear reason why. Now, my question to you is that, do you know what is the reason that you come over to the futures market? Okay, so by the fact that you are here in this webinar, it shows that you more or less have some interest in the futures market, right? And do you know why do you need to trade futures market or not? And what are the advantages in the futures market that you can actually capture so that you are able to reach your goals? So this is where I will be discussing these particular topics, the trading strategies and opportunities in the futures market that can actually help you enhance your return and reduce your risk. So whether you are new to futures trading or have years of experience in trading, I guarantee you that you will find something new and eye-opening this session. And in the next hour, we will cover a range of topics, including the 7 trading ideas for different types of futures contract and how you can actually spot profitable opportunities in the market and how to diversify your portfolio with futures trading. So we will gain some insights on how to apply these ideas to your trading style as well as your background. So let's get started. And I encourage all of you to take some notes and ask questions during the session. And by the end of it, you will have a better understanding on how to trade futures and be more confident in your ability to diversify your portfolio. Now, before we begin, I want to give a quick disclaimer. This presentation is for educational purposes only, and it's intended to give you a high level understanding of trading concepts. It's definitely not a substitute for a detailed study and the development of effective trading methods. You will still need to put in some effort on your side to develop trading strategies that suit your individual needs. Okay. So that being said, I hope that today's session will help you, widen your horizons and expand your knowledge of trading, especially in futures. So whether you are a beginner or an experienced trader, there is always something new to learn, and I'm confident that you will find valuable in the insights that I will be sharing with you today. So let's get started. As Ting Ting mentioned earlier, my name is Chuen, but you can just call me CY. So without further ado, let's dive into the content and explore how you can take advantage of the unique features of the futures market to enhance your trading performance. Now, I will be diving into 4 key topics that will help you become a more successful futures trader. So here's what you can expect. So the first topic, why a one-size-fits-all strategy does not work. Many traders make the mistake of thinking that there's a single strategy that will work for everyone in every market. We will explore why this isn't the case and why it's essential to develop a strategy that tailored to your unique needs and goals. Topic 2, I will be covering the trading strategies and techniques, what works and what doesn't work. So with so many trading strategies and techniques out there, right, it can be challenging to know which ones are worth pursuing. So here we will take a closer look at some popular strategy and technique and examine what works and what does not work. Topic 3, I will unveil some of the secret advantage of futures market as compared to the stock market. So with both markets have their unique advantages, and there are some benefits to futures trading that often go overlooked. So we will uncover some of these advantages and explore how you can leverage them to improve your trading. And lastly, in this final topic, I will share the 7 unique trading ideas that are tailored to the futures market. Okay, so these ideas will help you diversify your portfolio, enhance your overall return, as well as reduce risk. So are you ready to take your futures trading to the next level or not? So if you're ready, you can type in ready or yes in the chat box. And let's dive in. Now, before we begin, as I see that there are a number of participants here, let's take a quick poll. How many of you here are new to futures trading? You can type in new or yes if you are new in futures trading, so I can adjust my delivery method accordingly. And later on, I will share with you various trading strategies and opportunities that are available to retail traders. Okay, so it's not just strategy for the big guys, but also it's a strategy that you as retail traders can use as well. And whether you are new to futures trading or have several years of experience, the strategies I will be discussing today may offer some insights and ideas to help you enhance your portfolio, reduce risk as well as protecting your investment. Okay, so please stay tuned until the end to get the most out of this session. I can see that from the chat box, majority of you are actually new. That's good. Since you are new here, right, and I would say that today you be lucky that some of these strategies are actually considered as advanced strategies, and it will be good to give you some exposure of these strategies so that you can know that although you are just only in Malaysia, right, besides the stock market, we also have the futures market that you can actually utilize in terms of building a solid portfolio. Now we are going to take a deeper dive into the basics. Taking a deeper dive into the basics is actually crucial for gaining a better grasp of the subject matter. Now, by analyzing the foundational concepts, we can identify any gaps in our knowledge and clarify any misconceptions. This deeper understanding can actually help us make more informed decisions and build a more comprehensive trading approach. Now let's get started with the first topic. In this topic, we will be discussing why one-size-fits-all strategy does not work for all markets. And it's important for you to understand this because many traders fall into the trap of using the same approach for almost every market that they trade without considering the unique characteristics for each one. I believe this is also a very common mistake that maybe you did in your trading as well, where you just only rely on one particular strategy to trade almost every stocks and every market. So in this topic, once we have established the basics, we can start to look at the differences between markets and why one-size-fits-all approach is not effective. For example, when you understand the opportunity available in each market, we can develop tailored strategies that are better suited to the specific conditions of the market that we are trading in. Now, as you know that this phrase, one size fits all, right, it actually refers to a solution or an approach that is designed to fit all situations or all individuals without considering their unique needs or circumstances. Now, this may be convenient in some cases, and it's important to recognize that different situations may require a customized or tailored solutions to meet the specific needs. In the context of trading, applying one-size-fits-all strategy may not work for all markets, because each market has its own unique characteristics, such as differences in volatility, liquidity, as well as trading hours. Even the fundamentals are different as well, which may require you to have different trading strategies and techniques in order to be successful. Now, by understanding these differences and tailoring your approach accordingly, you can actually increase your chances of success and reduce your exposure to unnecessary risk. So before jumping into trading, it's important to take a closer look at the basics and understand the unique characteristics of each market. And by doing so, you can develop a more effective approach and increase your chances in achieving your trading goals. Now let's have a look at one of many trading strategies that traders can use to make trading decisions, which is the simple moving average for 20 days. So in other words, we call it the 20 days SMA. This is a popular technical analysis tool that is often used to help identify trends in the market. And specifically, the SMA looks at the average price of the whatever product that you're trading over a specified time period. So using this is actually 20 days is a commonly used time frame. The SMA can help us as traders to smooth the short-term fluctuations and the volatilities of the product that you're trading, making it easier to identify long-term trends. However, one thing that is called however, it's important for you to keep in mind that there is no trading strategy is foolproof, and there is always the risk of losing money in the market. But ultimately, we would want to look at after a series of trades, for example, 100 trades, 200 trades, 300 trades down the road, whether is it still profitable or not. Besides that, different strategies may work better in different market conditions. So it's important to be flexible and willing to adapt your strategy whenever possible. Now let's have a look at some examples using the 20 days moving average to trade the market. So on the left here and on the right hand side, there is two charts here. Both charts, you can see there is a moving average line. Both are using 20 days simple moving average. The chart on your left hand side is actually a trending stock, and the chart on the right hand side is a not so liquid stock, but it is trending slowly. So here, can you let me know which of these are generally easier for you to trade? If you think left hand side is easier to trade, you can type in left in the chat box. And if you think right hand side is easier to trade, you can type in right. Let me know what do you think on this chart. Which of these charts would be easier for you to using this strategy to trade? Okay, I see some minority said both charts. That's interesting. And I can see most of you have a consistent answer, which you say left-hand side chart would be easier to trade for a trending stock because it is highly liquid and it shows that the trend is clear and easy for you to identify and make decisions, right? So one example simple here is that you can see although the same strategy, but it does not work for all stocks. Okay, even though both are from the stock market, but different stocks just have different characteristics. Now the next example, let's compare how about for the futures market. Same thing. Let me show you the first chart first, and then later on the second chart. So this one, we will be using again same strategy, a 20 days moving average on FKLI to trade the index futures, and the next chart would be on for FCPO Same thing, 20 days moving average to trade the commodity futures FCPO. Let me show you one time, and then let me know which of these is easier to trade, whether is it FKLI or FCPO. Both of them are actually having the same period of time. Okay, so the first chart would be FKLI, and the second chart would be FCPO. Now, let me know in the comment box here which of these market would be easier for you to trade if you were to use the 20 days simple moving average, whether is it FKLI or FCPO. There is no right or wrong answer because for the same SMA, right? I believe each and every one of you would have a different strategy when it comes to application. So I see some FKLI and majority put FCPO. Okay, no. Now the one thing that I want to show you here is that throughout these examples is that regardless of what strategy that you use, early on here we are doing a simple experiment, right? Just only using one common indicator that each and every one of you here can understand. But ended up we have different kinds of opinions. Some prefers FKLI to trade using SMA. Some prefers FCPO. So it doesn't really matter because with the earlier examples, right, you can notice that each market and each financial product has its own unique characteristics, including the factors like volatility, liquidity, even the fundamentals that affect them can be very, very different, and many all other factors. So this is why this makes it difficult to use one size fits all trading strategy that works well across all markets. And you can see clearly for yourself that stocks and futures are entirely very different. Even comparing both futures product, right, FKLI and FCPO, they are different as well. So in order to be successful in trading, one piece of advice is that you need to tailor your strategies to the specific market and the specific product that you're trading in, as well as you need to tailor it to your own individual personality and risk tolerance. This means you also need to take into account factors such as your trading style, your preferred time frame, and your goals as a trader. And by doing so, you can develop a personalized approach to trading that is more likely to be effective in achieving the results that you want to get. Now, the second topic, in this topic, I am going to share with you the two major types of trading strategies. Okay, what works and what doesn't work. What are the challenges? Because each strategy has its advantages as well as a drawback. So it's essential for you to consider your personality, risk tolerance, as well as the market condition when selecting or even developing, crafting out a trading strategy, because a strategy that works well for one trader may not necessarily work well for another trader. And what works well today may not necessarily work well tomorrow. And when it comes to trading, the key is actually flexibility, adaptable, and continually adjust your strategy as needed. But besides flexibility, right, the most important thing among all is actually discipline in terms of following your trading route. Okay, that is the number one thing before it comes to being flexible. Now, let me share with you this table where we compare about two different trading strategies. Now, generally speaking, trading strategies can be divided into two main types. Okay, left hand side is the mechanical trading strategy, and right hand side would be on the discretionary trading strategy. Now, I'm not going to go through everything. I'm going to highlight the important things for you here. Now, let's get started with the mechanical trading strategy first. Now, how many of you here has heard of this word before, mechanical as well as discretionary trading strategy? If you have not heard of this word before, you can type in no in the chat box. So let me know that this is actually something new to you. in fact, it's actually very, very simple. All of us, you do apply this somewhere along the line in your trading. It's just that you haven't get into this term or this jargon before yet. Okay, I see majority of you have not seen this word before. Okay, let me describe these differences to you, and then later on, after I explain to you the differences between these two trading strategy, and then later I will ask you which of these strategy that you actually applies in your current trading. Okay, now let me get started with the mechanical trading first. So for mechanical trading strategy, okay, the keywords here are mechanical. Okay, mechanical means something like robotic, right? So it is fixed, standardized, and it is based on the rule. So when you trade with mechanical trading strategy, you are going to have a few trading rules, okay, very few trading rules, and you are going to stick with those rules very, very strictly, like a robot, okay, which means when your trading strategy shows you a buy signal, you buy. When it shows you a sell signal, you will just sell. Okay, so you can see that when it comes to analysis, it's easier to analyze and easier to make trading decisions based on mechanical trading strategies, because majority of the mechanical strategies here are technical indicator based and are easy to back test. As you can see, mechanical trading strategies here are well suited for a lot of traders, especially the novice traders, because it is systematic and easy to apply. So this first part is for mechanical trading strategies. Now let's go over to the right-hand side, which is the discretionary trading strategy. Now, the difference here is that for discretionary trading strategies, it is quite similar to mechanical trading strategies, but the difference is actually in terms of when it comes to application. As the name implies, discretionary, right, means discretion. It means that you have a freedom to decide what you should do in a particular situation. So when you apply discretionary trading system, there are lots of flexibility. So it means you need to have judgment, you need to have experience, and you also base your intuition to make trading decisions. So simply speaking, for discretionary trading strategies, it is, besides on having rules, right, you also based on, make decisions based on your own judgment. And when it comes to analysis, now here's the catch here. It can be very challenging for discretionary trading strategies because it is subject to your own interpretation as well as your own judgment. Although you may have trading rules, at times you will bend those rules according to the market conditions. You heard it correctly. If you use discretionary trading strategy, meaning that you will bend those rules according to the market conditions. So, for example, when your discretionary trading strategy shows you a buy signal, you can choose to buy or choose not to buy depending on your judgment based on the market condition and many other variables. And of course, this is better suited for experienced traders, meaning you need to fulfill several conditions first before you use discretionary trading system. Number one, you need to be able to strictly follow trading rules. When your trading strategy tells you to buy, you buy. When your trading strategy tells you to sell, you sell. When it's time to cut loss, you cut immediately without any hesitation. So those are the conditions before you are able to apply discretionary trading strategy successfully. So those are the requirements. And besides that, you also need to be able to understand the market well in order for you to tweak and adjust your trading strategy. Now, let me ask you this question. Based on my explanation here, okay, the differences between mechanical trading strategy and discretionary trading strategy, based on your current trading approach, can you easily identify which of the strategy that you use in your trading? Let me give you an example. If you can easily identify the market trend within 2 to 3 minutes, and then you can make a quick trading decision. Then you actually considered as a mechanical trading strategy. However, if you are you takes more than 5 minutes, 10 minutes, even 30 minutes down the road, right, you still unable to decide to make a trading decision, then you are very likely to use a discretionary trading strategy. So let me know in the chat box here if you use mechanical trading strategy, where you can make decision very quickly in a very short period of time. You can type in M for mechanical, M McDonald's in the chat box. Or if you use discretionary trading strategies, you can type in D in the chat box. Because it is a very important here, especially if you're still new in trading, it would highly recommend for you to start with mechanical trading strategy first, until you have been developed the necessary good trading habits. Then you can actually start to move over to discretionary trading strategy. If you are doing discretionary trading strategy and you still find it very difficult to make trading decisions, then it would good for you to temporarily move over to mechanical approach first, to practice on your decision making muscles. Once you're good in that, you can actually slowly take your time to move over to discretionary trading system. I see our audience here, you have combination of people who use mechanical and discretionary. Okay, that's very good. Now, mechanical trading strategies, of course, you need to understand the pros and cons here for both strategy. Mechanical strategy works well in both volatile and trending markets because they are based on the fixed, standardized, and rule-based approach, right? Which makes them easy to analyze and execute, which is why it is considered as very popular among traders. However, I do notice that a lot of mechanical traders, right, when it comes to application, they are actually discretionary based. Okay, why mechanical trading? Because they are easy to analyze, easy to execute. However, mechanical trading strategies may not work well in a sideways or a low volatile market, especially when the market does not show a clear direction. So in such market, the trading signal may be unclear, which makes the inaccuracy in terms of trading decisions. But if you are a firm believer of mechanical trading strategy, in fact, you don't really, you don't really mind, even though when you trade during side markets, because you have your own set of philosophy in terms of applying mechanical trading approach. And historically, mechanical trading strategies have been successful specifically for commodities futures, because you can trade both directions. And price movements in commodity futures tend to be more predictable and trend-based. And the trend in commodity futures generally lasts a little bit longer compared to stocks as well as indices. Now, the next thing, which is on the discretionary trading strategies, potentially can work well for all markets, but they require customization to fit each market unique characteristics. Unlike mechanical approach, discretionary strategies are also rule-based, but it still requires your trader's judgment as well as your experience in order to make decision. So this makes it a discretionary approach more difficult to analyze and a little bit hard in terms of execution on making decision compared to mechanical strategies. Okay, because each market has its own unique characteristics, including the fundamental factors that shapes its the conditions. Because you have different sets of volatility, liquidity, stock market and futures market are different. Index futures and commodities futures are also entirely different thing. So it's important for you to understand these factors when trading or even investing in markets to make informed decision that align your investment goals. Now, most traders tend to specialize in either one product, right? Either you just trade stocks only or futures only. Now, regardless of which product you trade, there are two major types of analysis that traders use to make your decision or to form your trading strategies. So the first one would be technical analysis, and the second one would be fundamental analysis. Now, of course, some of you might be combining these both of analysis in order to develop an effective trading strategies to profit from the market. Now, one more thing I can actually suggest you in terms of improving further on your trading strategies. Now, you may notice that one key differences that between professional traders and retail traders is that the professionals have a deeper understanding of the products that they trade. They are more familiar with the characteristics of the financial products that they are specialized in, and are better equipped to develop trading strategies based on this knowledge. So which is why they are quite good in the products that they trade as well. So if they trade in stocks, they are very familiar with stocks. If they trade futures, they understand the futures product very well as well. So by developing, if you can actually develop trading strategies, if you have good product knowledge as well, or understanding of the financial product that you trade, you can develop a more improved version or an effective trading strategies. Of course, it requires a willingness to invest time and effort to learn about these products and the factors that impacts the market. Okay, so in summary, if you have a deep understanding of the financial products you trade, it can definitely help you develop better trading strategies and achieve greater success in the market. Now, last but not least, is the last two topics, topic 3 and topic 4. In this section, I am going to combine both topics together. We are going to explore the relationship between futures trading and stock trading, and how you can integrate both to create a diversified portfolio that maximizes your investment potential. Now, of course, futures trading is unique in many ways. It offers traders to access a wide range of markets that are not available through traditional stock trading. When you are able to incorporate both futures trading into your investment strategy, you can actually gain exposure to the commodities market as well as the indices that can help you further diversify your portfolio and minimize your risk. Now, before we get into the 7 trading ideas, let's go back to the basics and explore some of the key advantages of stock trading, of trading futures contract. Okay. Now, the first one, of course, in futures trading, you can trade both directions. One of the benefit of futures trading is that you can profit from both upwards as well as the downward market movements. This is because futures contract allow you to take both long and short position, giving you more flexibility to take advantage on the market trends, regardless of market is going up or coming down. The second advantage is on leverage. Futures contract also offer leverage, meaning that you can control a large amount of underlying asset with just only relatively small investment, which is your initial margin as a deposit. So this can help you maximize your returns, although it is important to be aware of the risk associated with leverage trading. And the third thing is on liquidity. Futures market are highly liquid, meaning you can actually buy and sell contracts at any point in time. This can help you capitalize on market opportunities and manage your risk more effectively. And lastly, on diversification. Now, I understand that most of you here, when you come to trading, you want to make the most money out of it, right? Especially during uptrends, very few traders think about diversification. Until the market upsets and market hits south, or whenever there's crisis, prices coming down, right? This is where a lot of people, rush into, finding what are the things that I can manage my risk, what are the things that I can diversify. So it is important if you have a good product knowledge in futures trading, because futures contract allow you to diversify your portfolio by gaining exposure to a wide range of asset classes and market. Okay, so later on, I'm going to share with you, incorporate some of the diversification strategies in some of the 7 trading ideas. Okay, so in short, trading futures gives you a lot of advantages, as well as the ability for you to profit from up and down markets. It has leverage, liquidity, and you can diversify to enhance your return and manage your risk more effectively. Now, let's get into the first trading idea. The first idea is that if you are not sure what to buy when the market is going up, you can consider taking a long position, which means you can buy index futures, take a long position in futures, index futures, to participate and move together with the market. All right. Now, for example, when you have a global good news, when you have news such as like economy recovering, improvement in economic fundamentals, pre or post elections, expectation when the market is going up, or even any positive elements that can potentially drive the market sentiment up. Okay, so this is where if you're not sure what to buy in the stock market, you can actually take a position in index futures by betting the index futures up. So why index futures? This is where when you long index futures, you can gain exposure in the market very quickly, compared to slowly take your time to research for potential stocks. Now let me differentiate the differences on between stock and futures. Left hand side will be stock, and later on I will share with you the differences in futures market on the right hand side. If you are trading or investing in stocks only, of course, each and every single stock has its own individual stock specific risk from various components, such as earning risk, industry and sector risk, whether the company management is good or not, the financial health of the company, and many other factors. So in Bursa Malaysia itself, there are over 1,000 counters, right? When the general market is up, you may not have the time to analyze the stocks. And I believe even though currently you have stock screener, right, you will still need to take time to do stock selection. Am I right? So if you just only have, if your world is only limited to stocks, so this is where it has a limitation there. But if you do consider about the futures market, the fastest way to gain exposure in the market is actually using futures contract. So when the general market goes up, okay, meaning index has to goes up, right? If FBMKLCI goes up, means FKLI has to goes up. So you can take advantage of the index futures. In Malaysia, we have FKLI as well as the FM70 that tracks the general market sentiment. And besides that, when you trade futures, you don't need to worry about the stock specific risk, because FKLI, for example, is a basket of the top 30 market capitalization companies in Malaysia. You are already well diversified by taking a position in FKLI. So by using index futures, you can reduce your time in analyzing the individual stock. So let me know whether do you like this trading idea number 1 or not. If you like this idea, you can type in yes in the chat box, or you can give a thumb up here. All right, because this is a very basic in futures trading, and I do notice that although many people understand basics of futures, but they never consider this as a trading idea that they can actually take advantage of. You can actually utilize trading idea to take advantage of the market. All right, so here number 1 thing, if you do not know what to buy when when the market goes up, you can actually long index futures, because sometimes even when you select stocks, when you expect market to go up, right, the specific stock may not even market goes up for a lot of points already, the stock may not even move at all. So index futures is definitely a one suggestion that you can actually go to. Now, if you like this trading idea number one, there are still another 6 more trading ideas that you can actually take advantage of. Now, trading idea number two, if you are not sure what to sell when the general market is going down, then you can actually consider shorting index futures. Now, of course, a lot of people don't think about shorting index futures, right? Because I understand that maybe you're still new in futures market. You'll short index futures with a primary intention to capture profit in index futures. But in fact, using this strategy, right, you can actually this is considered as a hedging strategy that can actually protect your portfolio from losing its value. Let me describe it to you in another way. Now, let's say if you believe you are investing or trading undervalued stocks, okay, regardless of whatever strategy that you do in stocks, right? Whether is it value investing or growth investing, ultimately, it is based on undervalued stock, right? Because you believe that the stock value is way higher than the current value. Now, occasionally, you may be afraid that when the general market comes down, your undervalued stock may or may not go down with the market. Have you experienced that before? Because some stocks are less affected by the general market sentiment. So sometimes, when the market comes down, the stock that you are holding, right, sometimes it go up instead. So you want to hold your undervalued stock, I believe. So for those of you who are experienced in stock investing, I believe you understand this situation pretty well. When the market comes down, your stock may not come down at all. It may go up instead. So if you have an intention to hold your stock while at the same time, because market comes down, right, you are not sure whether your stock will be affected by the market. So how you can protect your stock portfolio if you want to keep your stock. Now, if you want to keep your stock, very easy using index futures is that while at the same time, if you're also afraid losing your stock position, or if you're also afraid that the value of your portfolio decrease, you can actually hedge your whole portfolio by shorting index futures contract, okay, which is you can either do it using FKLI or FM70. Okay, generally we would be using FKLI, right, because it tracks the whole market, right? You can use index futures to hedge and protect your entire portfolio. Why? Because when the market, let me have a quick draw for you. If let's say when stock goes down, you are losing money, right? And if you take a short position in a futures contract and you're betting the futures to come down, and a short position in futures contract, when markets comes down, you are actually making money from here. So left hand side and right hand side, if you were to add up together, it may ultimately reduce your losses in the market. Okay, can you see that? Does that make sense to you? Can you see the logic behind it when using index futures to protect your portfolio? This is one of a trading strategy, is what we call as the hedging strategy. So besides that, if you make money from futures during a downtrend, right, the profits from futures can be reinvested in stock as well. So it's considered as a double win if you were to employ add futures product into your trading, right? So this is trading idea number 2. Trading idea number 3. When futures market, it definitely has leverage to amplify your returns. Now, if you want to have a leverage in stocks, right? Of course, a majority of the retail traders do trade stocks, and of course, there are occasionally you may think of whether you can leverage in trading stocks or not. Yes, you can do that. Of course, if you want leverage in stocks, you definitely need to borrow some margin to trade, or borrowing money from the banks or from your stockbroker pledge some assets or stocks in order to get some margin to trade. Of course, this kind of borrowing, because you're borrowing money from the banks, right? It definitely will cost you interest. Even if you want to use stock warrant or stock options to trade, it's also going to cost you some of the time value there. Because across time, your stock option or warrant will reduce slowly, reduce value across time. So, which is why if you want to leverage using stock, it definitely has a cost there. However, for futures market, you don't need to consider about both costs. You don't need to pay interest to get leverage, and you also don't need to worry about other costs. Because for futures contract itself, it is already a leverage product, and it goes by contract specification, and it also has a very low trading cost. All you need to do is that you just need to have a fraction of the money, which is you need to fulfill the initial margin requirement, depending on what futures product you trade, as a deposit to open one futures contract and get exposure into that particular market, whether is it FKLI, FCPO, or gold futures. Okay, so this is trading idea number 3. Now, trading number 4 is also something I believe you are familiar. It's just that you may not understand the mechanism or structure behind it. Trading idea number 4, you can easily take a short position in the futures market. So you heard it correctly. In the futures market, you can take a short position relatively very, very easy. Now, how about the stock market? Can you take a short position in the stock market? Definitely you can. However, there are definitely some of the limitations if you want to take a short position in the stock market. If you do IDSS, which is the intraday short selling, you are unable to capture short-term downtrend. You can only capture the intraday trend only. So that means at the end of the day, you need to cover your short position, and then you need to do it on the next day. So that's the disadvantage for IDSS. Now, if you want to do a regulated short selling, and of course, there are many conditions to fulfill in order to have a short position. Not all stocks can short anyway, and I'm not going in depth into this RSS, the regulated short selling, because as retail traders, very less likely you are going to do regulated short selling, because there are a lot of structures, mechanisms that you need to fulfill in order to do RSS. So one of it is that you need to be able to borrow stock first in order to short, and occasionally, in fact, most of the time there are challenges in terms of finding stocks to borrow, because not everyone would want to lend their stocks, and even if you are able to borrow it, there would be limited amount. Besides that, borrowing stocks, you would still need to pay the interest for borrowing those who lend you stocks. So there are a lot of limitations in terms of doing short selling in stocks. So how do you solve that? Is that always remember that as Malaysia, Malaysian in Malaysia, right? We have futures market in Malaysia. We have Bursa Malaysia derivatives, where you can trade futures contract. You can directly short the market by taking a short position, and you don't need to borrow stock. You don't need to borrow other futures contract in order to short. Okay, there is no uptick rule, and you can immediately have an exposure in a downward market easily. All right, so that is one of the advantage in the futures market. You don't need to borrow or anything in order to short the market. You can take a short position in futures market very easily. Trading idea number 5. Now, of course, this is very applicable to you, especially those of you who who are still investing or trading in the stock market. Now, in the futures market, the liquidity is still high, even though in downtrend. At least the liquidity is not as low compared to the stock market. what do I mean by that? When a general market is coming down, okay, so I believe recently each and every one of us, encountered a downtrend in our Malaysia market, right, from 1005 index until now 1004. So when the general market is down, meaning the market sentiment is not good. So generally, buyers are more cautious and less willing to buy. So for those of you who are ready to buy, I believe you are also cautious and not so willing to buy in the stock market, right? So there will be low liquidity on the buyer side, especially during period of crisis, such as financial crisis, war, market crash, bubble bust, or all bad news, you can name it, right? If you're holding stocks and wanting to get out immediately in the market, it may be difficult to you, and you would have to sell down a lot lower price to clear off your position. So that is disadvantages in stock. So how you are able to solve that issue is that you can also use futures market to help you solve this problem. Is that futures market are highly liquid, meaning that they are constantly will be having buyers and sellers who are willing to trade. This makes it easier to buy and sell the futures market at a fair price. Now, besides that, this is also quite similar to a trading idea number 2, where you can use futures contract to hedge your portfolio during downtrend. Now, do you still remember what is trading idea number 2 or not? I give you some time to think about it. Trading idea number 2. Now, very simple. Trading idea number 2 is that if you're not sure what to sell when the market is going down, you can actually sell index futures. So if you were to combine idea 2 and idea 5, is that during a downtrend, you do not want to sell, or even if you want to sell and it is very hard to sell in the stock market, you can actually hedge your entire portfolio using the index futures. Okay, so this is trading idea number 5. Now we have another 2 more trading ideas which I definitely believe you can actually take advantage of the futures market. Maybe you haven't thought of it before. Trading idea number 6 is that if you add futures product into your portfolio, you can reduce risk and create a good diversification for your overall portfolio in general. Now, can you let me know what conditions you can profit from the stock market? Whether is it price up or price down for the stock market? Which of these conditions that you can profit in the stock market? Let me know if you can actually profit from stock market in when price comes down. Do let me know, because to my best knowledge is that the only way to profit from the stock market is actually when price goes up. Okay, because I also have already mentioned we still can do short selling in the stock market. It's just that there are a lot of regulations, a lot of requirements that we need to fulfill in order to do short selling. So generally for stock market is that we can only make money when price is going up, especially when there is expectation that the fundamentals is improving, whether is it fundamentals from the stock or the company itself, or the fundamentals from the country or economy as a whole. And of course, speaking about fundamentals, there are a lot of factors that can affect stock price that you need to analyze, such as again the earnings, company management, industry and sector, economic policy, and many other factors. But if you are going to trade futures or add futures product into your portfolio, you don't need to worry about all of these factors that are affecting stock, unless you are trading single stock futures. Okay, so you can actually trade index futures which represents a basket of stocks. So in Bursa Malaysia derivatives, we have FKLI, we have FM70, we also have the newly launched F4GM. Okay, you can actually search that more on Bursa's website. So in trading index futures, you only need to concern about the macro factors as well as the global factors, because index futures itself is already well diversified across different stocks from different industries and sectors. So you don't have to worry about individual stock risk at all. You don't have to worry about management in industry or the earnings from the stocks, because it is already well diversified. All you need to do is just only to analyze and take into concern about the macro as well as the global factors. Besides that, for trading index futures, you can trade both directions in the market, whether is it uptrend or downtrend. So earlier I've shared with you in trading idea 1 and 2 already. If you do not know what to buy in the market, you can take a long position in index futures. If you do not know what to sell in the market, again, you can actually take a short position in index futures to capture the downtrend. Now, the last trading idea, which is trading idea number 7, can definitely help you diversify your overall portfolio risk. Now, listen to this carefully. Trading idea number 7, different assets can actually create greater diversification benefits. In the stock market, even when you have stocks across different industries and sectors, there are still limitations in diversification. Now, you may be wondering why. Because all of them, stocks, even though you have stocks from different industries, all of them are still fall under the same asset class, which is stocks or what we call as the equity market. Remember, earlier I shared with you that all stocks strongly rely on earnings, management, and many other factors. Stocks still follow the general market sentiment and the economy. So how can you diversify through futures market? Now, number 1 is that you can use index futures to hedge your portfolio when the general market is down, because index futures are highly correlated to the stock market, because it's derived its value from the stock, right? So let me explain what correlation here means. Correlation means is that the relationship or the connection between two things or more things. So for example, when the stock market goes up, FKLI, which tracks the FBM KLCI, right, closely would also goes up accordingly. So for example, when the stock market goes up by, let's say, 5%, FKLI would also follow to goes up by 5%. So this is what we mean by high correlation. It has a high relationship between these products, stocks and index futures. However, in order to have better diversification for your portfolio, you need to have positions or other assets that have low correlation or zero correlation or even negative correlation to the stock market. Meaning, let me give you an example. Let's say if the stock market comes down by, let's say, 10%, and other assets comes down by only 2% or 4%, okay? Stock market comes down by 10%, other assets comes down by 2 to 4%, or maybe not affected at all. So this is what we mean by low correlation. So this is actually a very good thing, is that if you have low correlation assets or low correlation positions in your portfolio, your overall entire portfolio, when the general market comes down, right, it is not badly affected by, it will not drag by the general market conditions. So in futures market, Malaysia futures market, we have one category of futures product that are unique. Okay, do you know that? Which is the commodity futures. Okay, a lot of you understand FCPO, but you're not quite sure what FCPO actually is. In fact, FCPO is it falls under the category of commodity asset class. So in futures, we call it the commodity futures. It is a completely different asset class, and it has low correlation to the stock market over the long run. Even for the past 10 years, in fact, it has a low correlation, close to zero, or even zero correlation to the market. What it means is that whatever the stock market does, the commodity market does not care, and generally not affected by it at all. We have crude palm oil futures, which is the FCPO and FEPO, and we also have the gold futures, the FGLD. You can take into consideration whether to add into your portfolio, because it's definitely a good diversification assets you can add into your portfolio. Now, a very recent example is that I believe everyone has noticed recently, in fact last year, is the Russian-Ukraine war, right? Where it has affected, the general stock market negatively, even till to date. Now, how about the performance of the commodity market at, moving back at the point in time? Is that, guess what? The commodity markets are actually performing quite well. So here we can see that if you are able to add commodity futures into your overall portfolio, it would definitely help you enhance your overall return, while at the same time reduce your overall portfolio risk. Let me give you an example comparison between stocks and futures. Now here there is a diagram here. On the top, the line is actually representing stocks or FKLI, and the bottom would be FCPO commodity asset class. Here we can see that here is that of course for stocks generally you only be able to profit from upward direction, right? But for commodity futures, because it is a futures product, you can trade both directions, up and down. So you have an advantage to profit from both ways. So let's have a look and see both comparison to see how many opportunities that you can actually make from commodity futures compared to stock itself. I slowly move here. Okay, you can see that stock market moves sideways and commodity market moves up. You can profit from commodity markets. Here you can also see when stock market moves sideways, you still can profit from downward commodity markets, especially starting from year 2018, right? For those of you who have been investing in Malaysia stock market, you do know that the KLCI has been down from 1008 until today 1004 points. So which is where which makes stock investing a little bit challenging. However, if you are able to add commodities asset into your portfolio, you will definitely able to see an enhanced return. Now, one of the example would be on just at the end of year 2009, where when the stock market comes down, futures market actually goes up. So this is one of example that you can see that it has a really zero to low correlation. Whatever the stock market does, it doesn't really bother at all. All right. Now another example, which is the recent one, year 2020 until year 2022. Generally, Malaysia stock market is going sideways, but you can see that the commodity markets, the FCPO, is having a very strong uptrend. So if you also, for those of you who also invest or trade in commodity futures, definitely you would have a good gain or having a good return out from it. So now my question to you is that whether you would add commodity futures into your portfolio or not. I have already shown you the facts and some of the examples that you can take advantage of by just adding commodity futures into your portfolio. So that's it. Here are the 7 unique trading ideas for futures market. You can actually take your phone to have a snap on these 7 unique ideas, so that just have a thought about it, because today I'm not going in depth into the specific trading strategies, because I want to going back to the basics to to let you understand and see, the basic mechanism of futures market itself already gives you a lot of benefits that you can actually, craft and redevelop your own trading strategies so that you can actually help your entire portfolio to gain and enhance return, while also protecting your portfolio from if the general market weakens. So that's it. The 4 key takeaway points for you today is that I've already shared with you. There is no one size fits all strategy, because each market you need to customize your strategy as well as your personality to fit the opportunities that is available to the market. Secondly, you need to also customize the strategies depending on the product you trade as well. Okay, what works well in the stock market may not necessarily work well in the futures market. So it's important for you to tailor your strategy accordingly. Thirdly, futures market, I've shared with you, there are a lot of benefits you can actually take advantage on, especially, today I've already give you a quick look what ideas you can actually improve on, so that your overall portfolio would look nicer, even though when the market is bad. And lastly, the 7 unique trading ideas. Hopefully, some of these ideas is definitely applicable for you. So think about it. Which of these ideas is most applicable for you moving forward in the future? Even though it may not be applicable for you right now yet, it may definitely, as a standby for you, so that there is such trading idea that you can actually capitalize on moving forward, where just Malaysia itself, futures market definitely can help you not just only protect your stock portfolio, but also help you enhance your overall returns. So that's it for today. I've shared with you several trading ideas you can take advantage on. Now back to Ting Ting.